SCHD paid a record third quarter dividend at the end of September. And I told you all about that one. But SCHD wasn't the only dividend ETF to knock it out of the park. Today we'll explore why dividend growth is vital for both long-term investors and retirees. And we'll also check out how the top dividend ETFs stacked up on the third quarter dividend and other key metrics. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please dominate that like button, subscribe if you haven't already, and drop me a comment down below with your favorite dividend ETF or anything else that comes to mind. We had one new channel member this week. A huge shout out to the one and only Life is Wonderful. I appreciate you joining the channel membership, and I hope you enjoy the perks that come along with it. Your support, along with all of you that have been here all along, means the world to me. You know what time it is. Let's grow. Yield versus growth. I like to show examples why focusing on dividend growth rate is more important than reaching for higher yield. Dividend growth is objectively better long term, and I'll show you why here in a minute. But a great debate always breaks out on this topic. And frankly, for some situations, the people that are pro high yield are correct. Sometimes that high dividend growth won't pay the bills right here, right now, period. Something hit me like a ton of bricks yesterday, and I knew I had the perfect intro for this third quarter dividend growth update. Looking for high yield is the same concept as paying down credit card debt. When you find yourself in that situation, it is objectively the highest priority in investing. Now hear me out on this one, and I promise I'm not crazy. Actually, that's a lie, but this will make sense. If you have high interest credit card debt, then investing money into the market will have negative long-term implications compared to paying down that debt. You won't earn more on your investments than whatever the high interest credit card is costing you. What is it, 20%, 25% these days? You won't beat that. Just pay down the debt. Now, of course, it's better to invest your money early and often if you do not have any credit card debt. I mean, cool story, bro. What's your point? Yield and dividend growth work in the same way. High dividend growth will not help you if you don't have the necessary yield to pay your bills. In the same way that investing your money into the market will not help you if you have credit card debt. But if you have the high portfolio value or plenty of time left to build it, well, check this out. In this example, I'd like to congratulate you for winning $1 million. As you can see here, you won the thing. Now, here's the rub. You do not get the $1 million. You can't touch that principal. But you do have two options here. Option one, you get that juicy million that you can't touch yet, but it pays a 10% yield with a growth rate of 2%. This is your JEP-Q on steroids. So we can chase that starting high yield, that's a pretty nice scenario, or we can look at option two. We receive $1 million worth of SCHD. And this pays, and this is just from Seeking Alpha, its current yield, 3.42%, and it grows by 11.13% per year. And this is the current 10-year dividend CAGR, the average over the last 10 years. As you can see, the high yielding option looks very nice. That's option one, 100 grand in your pocket, year one. Option two, 34,200. One versus two, you get almost 66,000 more dollars. But let's just see the power of this growth rate against this growth rate, even having to make up being only a third or so of the dividend. So you can see with option one, after 10 years, you're at 119,000 a year to 88. You're still happy. After 15 years, you've noticed, oh, option two is not too bad, but you know, we could still reinvest up here. And so the difference, we're going option one. Well, after 20 years, we're bringing in $254,000 a year with option two, supposed to 145. Okay, it's starting to hurt a little bit, but it can't get too crazy after 30 years, right? 729,000 versus 177.5K a year. And let's just get to the point here. After 40 years, which is a long time, and these are not exaggerated, by the way, over $2 million of dividends per year instead of 216,000. Now, this is without reinvesting. And I just want to head this off. I did this in another video. I won't waste more time in this one. A lot of people's argument is, yeah, but you could reinvest the excess dividends here to buy more compared to here. And if you extrapolate that out, it actually makes option two exponentially more as time goes. You'll break even, you know, somewhere in here, and then it's just wild old house. So that's basically arguing against option 1 if we want to reinvest dividends. It synergizes even more with the growth in that scenario. But this is just a quick example to show the power and ridiculousness of dividend growth. 11% is a lot, and SCHD has done that. That's a fairly low starting yield. And the secret here, when you're down here, you're still about this yield. And that brings me to my next topic. Why do I always call yield a snapshot or vanity metric? And I wanted to cover this because I say it in passing and I don't want to cause confusion. Yield really is simply a vanity metric, except for the day that you make the purchase. Because all that yield is for stocks and ETFs, it works the same, is the dividend paid divided by the current price. Let's say you buy a ETF that's yielding 4%. But then it plummets in price. So all of a sudden, the next week, after the price falls in half, it pays the exact same dividend. Your yield literally changed from 4% to 8%. But guess what? Your yield on cost, which is all that matters over time, is actually still 4%. You don't make more money. It pays a dividend per share owned, period. So the yield is 100% irrelevant after the day you buy it. The day you buy it, it's a snapshot. The next day and there forward, it is a vanity metric. It really is. And that's the power of dividend growth. Something when we're looking at SCHD. So don't look at this. This is the current yield. That's the current dividend paid divided by the price. It means nothing after you buy it. And just to be clear, yield means everything for purchasing decisions that day. It's 100% relevant because that's the current dividend divided by the current price, aka the value you're getting. But what this 11% growth rate represents, the dividend growth rate, is the dividend paid divided by the old dividend paid. These never change. So dividends are paid on a per share basis. So if this dividend growth rate is 11%, you are actually, in reality, regardless of price, it's 100% irrelevant if it doubled overnight or if it cut in half, you are actually receiving 11% more dollars. So that's like getting a raise at your job. Do some math on paper. If you start, say you're making 50K, give yourself an 11% raise per year for 30 years. And you will be right up there with the crazy multimillionaires. But that is the power of dividend growth. It will always reflect reality, whereas yield means absolutely diddly squat, except for that snapshot of the day you buy it. That's the rub. Now it's time to see how the big four of SCHD, VIG, VYM, and DGRO performed in the third quarter. Third quarter key metrics. I know there are a lot of great dividend ETFs out there to choose from, but these four are my favorite to rack and stack on a quarterly basis. They are all popular, for good reason, have been around for at least 10 years, and produce an attractive mix of yield, dividend growth, and total returns. Now, I'll admit that VYM isn't quite on par with the other three, but it does give us a closer yield comp for SCHD. Let's see how we're looking after a lucrative third quarter of dividends. I made this spreadsheet to track the dividend growth leaderboard over time of my four favorite dividend ETFs here. So you can see that this is year 2024, quarter 3, and these are live. You can change them to see how historical data played out, but we'll stick to the current one here. And what I have here is a scoring system that equally weights, it just sums up the 1, 3, 5, and 10-year dividend growth rates for each ticker. And the highest score, of course, is in the lead, I guess you could say. So right now, on the dividend growth history, SCHD is first, VIG and DGRO are battling for second, and then VYM is in a pretty deep third. Now, you can see quarter over quarter is just third quarter versus third quarter a year ago. SCHD had that juicy 15.3% increase, its biggest third quarter payment ever, as I mentioned in my recent SCHD video. But VIG had a nice growth of 8.4%. DGRO slowed down a little at 3.8. This is kind of like SCHD last year. And then VYM actually stepped his game up at 8.5, which would be good for second place. Now, I don't put quarter over quarter in the scoring system here. This is just more for your information because I don't think it's quite as important as the rolling time periods. But you can see over the last year, SCHD has been at 12%. And VIG and DGRO have been right around 8. Oh, and VYM actually for that matter. Basically a three-way tie for second. If you zoom it out for the 3-year dividend growth rate, the champion, and we'll actually just sort here as we go, the champion is VIG, and then DGRO and SCHD are basically in a two-way tie for second, and VYM starts to fall behind. Now, the most important ones in my opinion are these ones by far, because I'm all about long-term investing. For the 5-year growth rate, the champion is SCHD by a couple percent over VIG, DGRO down by 1% or so, and then VYM coming in the caboose, which it usually does on growth rate. It's more of a high yield, but that's the other thing. I put yield here just as an FYI, and these are just hand typed in by me, because yield's always changing. VYM is usually lower on the growth rates because it's higher on the yield. It's high yield compared to these ones historically. Look at SCHD. Highest on the growth rates, highest on the yield. And we'll get into total return next. It's kind of crazy, honestly. But then the big dog, I would say, is the 10-year, of course. And that's where SCHD is at that 11.13%. DGRO's 9-year CAGR, it's only been around for 10 years. So the 10-year out on like Seeking Alpha will show it's like 20-something%, but it doesn't have a full first period to compare to, if that makes sense. So I do as much as I can get a full year versus a full year. The 9-year CAGR is 9.91. VIG is a solid 8.41, and VYM is 6.81. Now I should mention, these are all crushing inflation. That's the power of dividend growth ETFs in general compared to high yielders like JEPQ and Devo. These will consistently grow because these are companies growing their dividends. That's the makeup, not just call options and derivatives. If you have the portfolio value to support make, get, and buy initially, these guys are your best bet. Whatever you're making now from them, they're only going to crush inflation over time. And I should lastly mention, I probably should have started with this, but I never do it right. This spreadsheet is out there if you want to see. It's free. Anyone can use it. See the links below. It's just a tab. It'll have some examples of each one. Like this is SCHD's tab. And then I also have like the raw data. I actually use this to check Seeking Alpha and other sites to make sure they have the correct numbers. This started as just a raw data audit for me, and I've slowly evolved into something I can share each quarter just to track the growth of these bad boys. Now, let's get to the total return. Now today we're only going to look at a zoomed out return, because if you're a dividend investor and you're living on this income and you want to beat inflation with dividend growth, yes, you care about total return, but short term means nothing. You're just reinvesting or living the good life. Long term, you want to make sure you're not falling into a yield trap and going with something high yield, but all of a sudden your value is diminishing. See, I'm proving that I love all of my children equally because I actually have VGT pulled up for some reason. But anyway, this is just the total returns over the last 5 years for my high yielders, SCHD and VYM are here, and my lower yielding high growers, or at least supposed to be the highest growers, VIG and DGRO over here. So on the 5-year, we have SCHD at 87.8% total returns. That's dividends reinvested. We have second place is VIG, 84.4. Third place, right by VIG. It's so close all the time with these two. I love the battle. DGRO at 83.42. And then VYM, and we expect this total return to be low. Frankly, these total returns should be lower than these in general because they're higher yield and they're less focused on growth, but it's trailing at 72.7%. And then the last 10 years, which is the one I really care about, the champion is DGRO at 220.4%, just ahead of VIG. Of course, they have to be close all the time at 217.4%. And SCHD really separates itself from VYM here, and with the higher yield and the good growth rate and the good total return at 210%, just behind the other two. And VYM 169.59%. In the 5 and 10 year, the three of my favorites are beaten up on VYM a little bit and really close to one another. The jury has closed this case for now. My dividend choice. As much as I emphasize dividend growth, I also highly value dividend yield and total returns. I really do. SCHD has had the best balance of that trifecta for a long time now. It also fits incredibly well with my favorite growth ETFs that I hold, VGT and QQQM. It has very little overlap with them compared to the other dividend ETFs. It is my dividend ETF of choice for my modern 3-fund portfolio that has significantly outperformed the market over the past decade. And it's not just for that perfect fit either. I think its methodology really does separate it from its other dividend ETF peers, and that it will do well in a variety of markets in the coming decades. Thanks for sticking with me on this one. Check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated, freedom is not. Thanks for watching, and I will see you in the next one. Peace.